welcome to a deep dive, into the world of Warren Buffett.
Oh, yeah.
We're going to explore the investment philosophy, that's made him a global icon, a philosophy rooted in patience, discipline, and, a deep understanding of value.
What's fascinating about Warren Buffett is that his journey from delivering newspapers as a kid
Right.
to becoming one of the world's wealthiest individuals
Yeah,
embodies the principles he preaches.
totally.
It's a testament to the power of, long-term thinking
Yeah.
and a commitment to lifelong learning.
Absolutely. And that's what makes this deep dive so valuable for all of us.
Right.
We're going beyond the headlines and uncovering the core tenets of Buffett's strategy,
Yeah.
those guiding principles that can apply to anyone, regardless of their financial background.
One of the most fundamental concepts in Buffett's approach is patience.
Okay.
He's known for his long-term investment horizon, often holding stocks for decades.
Yeah.
He sees market fluctuations as opportunities, not threats, and avoids impulsive decisions driven by fear or greed.
That sounds incredibly difficult in
Yeah.
today's fast-paced world.
It is.
How do you think he manages to stay so grounded and focused on the long game?
It all comes down to having a clear investment philosophy
Okay.
and sticking to it even when the market gets turbulent.
Mm-hmm.
Buffett is incredibly disciplined.
Yeah.
He doesn't chase trends or get swayed by short-term noise.
Right.
He's playing a different game,
Got it.
one with a much longer time horizon.
So it's about tuning out the daily chatter and focusing on the fundamentals.
Exactly.
Yeah.
It's about understanding that true value takes time to materialize.
Yeah.
It's about resisting the urge to react to every market swing
Mm-hmm.
and instead focusing on the intrinsic worth of the businesses you invest in.
And that brings us to another key principle, the circle of competence.
Yeah,
Buffett emphasizes the importance of investing in what you understand.
that's right. He's famously said,
Yeah.
I don't look to jump over 7-foot bars. I look around for 1-foot bars that I can step over.
Okay.
He believes it's crucial to stay within your area of expertise
Yeah.
and avoid investing in businesses that are too complex or outside your grasp.
So it's about recognizing your limitations and focusing on what you know best.
Yeah,
It's about acknowledging that you can't be an expert in everything.
precisely.
Okay.
It's about understanding that trying to be a jack of all trades in the investing world
right.
can lead to costly mistakes.
Yeah.
You're more likely to make sound judgments
Mm-hmm.
when you're dealing with familiar territory,
Okay.
with industries and businesses you truly understand.
That's a powerful lesson,
It is.
especially for those of us tempted to chase the latest hot stock
Right.
or invest in something we don't fully comprehend.
Absolutely.
Yeah.
It's easy to get caught up in the hype and make impulsive decisions.
Right.
But as Buffett has shown,
Yeah.
sticking to your circle of competence is a key ingredient for long-term success.
And speaking of making sound judgments, one of Buffett's most famous concepts is the margin of safety.
The margin of safety is all about buying assets at a discount to their intrinsic value.
Got it.
It's like having a built-in cushion to protect you from potential losses.
Okay.
It's about recognizing that the market can be irrational
Right.
and that prices don't always reflect a company's true worth.
So it's about finding those hidden gems that the market has overlooked.
Yeah,
Those undervalued opportunities where the potential upside outweighs the risk.
exactly. It's about being patient and waiting for the right opportunities.
Right.
Those situations where you can buy $1 for 50 cents.
Right.
Buffett is a master at this.
Okay.
And it's a key reason for his incredible track record.
So patience, circle of competence, and margin of safety.
Mm-hmm.
These are starting to sound like the building blocks of a successful investment strategy.
They are. And to
Okay.
really understand how these principles work in practice,
Yeah.
we need to explore the concept of intrinsic value.
Okay, let's unpack that. What exactly is intrinsic value?
Mm-hmm.
And how does Buffett determine it?
Intrinsic value is essentially what a business is truly worth.
Okay.
It's not about the current stock price. It's about the underlying fundamentals of the company. Its assets, earnings, growth potential, and management quality.
Right.
Buffett believes that the market price will eventually reflect intrinsic value,
Okay.
but it can take time.
So it's about looking beyond the market noise and understanding the core drivers of a business.
Yes,
It's about separating speculation from reality.
that's right.
Okay.
It's about doing your homework, analyzing financial statements,
Mhm.
understanding the competitive landscape,
Yeah.
and assessing the long-term prospects of a company.
Right.
It's about developing a well-informed view of what a business is truly worth.
And that brings us to another critical element of Buffett's approach, focusing on high-quality businesses.
Buffett is known for investing in companies with strong competitive advantages,
Mm-hmm.
durable brands,
Okay.
and capable management teams.
Uh,
He understands that these businesses are more likely to weather economic storms
Right.
and generate sustainable profits over the long haul.
So it's not just about finding a bargain.
Right.
It's about finding a great business at a reasonable price.
Exactly. It's
Oh.
about recognizing that sometimes it's worth paying a premium for quality.
Yeah.
Buffett is willing to pay a fair price for
Wow.
exceptional businesses with strong fundamentals
Right.
and enduring growth potential.
This is starting to paint a clear picture of Buffett's investment philosophy.
Yeah. But what about risk management?
Right.
How does he mitigate potential losses?
Buffett is a strong advocate for diversification,
Okay.
spreading his investments across different industries and asset classes.
Mm-hmm.
He believes that this helps to reduce the impact of any single investment going sour.
Got it.
He's also famously averse to leverage,
Okay.
avoiding excessive borrowing that can magnify losses.
So it's about not putting all your eggs in one basket
Yeah.
and avoiding risky bets that could wipe you out.
Precisely.
It's about managing risk prudently and avoiding unnecessary exposure to volatility.
Mm-hmm.
It's about understanding that even the best investors make mistakes,
Right.
and diversification can help to mitigate the damage.
This is all making perfect sense.
Good.
But I have to ask.
Yeah,
It's not just about the numbers, is it?
you're right.
There's a human element to investing, right?
You're absolutely right.
Okay.
Buffett often talks about the importance of psychology in investing.
So it's not just about what you invest in, it's
Yeah.
about how you think about investing.
Exactly.
Okay.
It's about overcoming common biases like loss aversion,
Mm-hmm.
the tendency to feel the pain of a loss more strongly than the pleasure of a gain,
Right.
and overreaction bias,
Okay.
the tendency to overemphasize short-term events and ignore the long-term picture.
This is fascinating. It
Yeah.
sounds like mastering your own emotions and thinking rationally
Mm-hmm.
is just as crucial as understanding financial statements.
Absolutely. Buffett's success is a testament to his incredible discipline,
Yeah.
his ability to stay calm and rational even when the market is in turmoil.
Right.
It's about making decisions based on logic and reason, not fear or greed.
Okay. We've covered a lot of ground here.
We have.
From patience and circle of competence to margin of safety and the importance of psychology.
Yes.
Now, I'm eager to see how these principles played out in real life.
Okay.
Let's dive into some case studies of Buffett's most successful investments and see these ideas in action.
Let's start with the Washington Post.
Okay?
A classic example of how Buffett identified a quality business at a bargain price
Right.
and how his patience and long-term vision paid off handsomely.
I'm all ears. Tell me more about this iconic investment.
The Washington Post in the early 1970s
Okay.
presented a unique opportunity.
Hmm.
The market was in a slump, and
Right.
even blue-chip companies were struggling.
Yeah.
But amidst this turmoil,
Yeah.
Buffett saw a glimmer of value.
So he wasn't deterred by the overall market gloom.
No, he wasn't.
What did he see that others missed?
He saw a solid business
Okay.
with a rich history and strong brand recognition.
Right.
The Washington Post wasn't just a newspaper.
Yeah.
It was an institution.
I see.
And while its stock price had taken a hit,
Okay.
its core business,
Mhm.
with its flagship publication and Newsweek magazine,
Right.
remained strong.
Okay, so he recognized that the market was undervaluing a quality asset.
Yes.
But wasn't there more to it than that? Didn't he also have a personal connection to newspapers?
You're right. Buffett's affinity for newspapers goes back to his childhood,
Right.
when he delivered papers himself.
Yeah.
That early experience gave him a deep understanding of the industry
Okay.
and a sense of its enduring value.
That's fascinating.
Yeah.
It's like his personal history informed his investment decision.
Exactly.
Oh, right.
And this wasn't just sentimentality.
Right.
He recognized that good newspapers had a loyal readership
Mhm.
and played a vital role in their communities.
Mm.
They possessed a moat,
Right.
a competitive advantage that protected them from easy disruption.
And I bet he also looked at the management team, right?
Yeah.
Especially Catherine Graham, the publisher at the time.
Absolutely. Catherine Graham was a remarkable leader,
Yeah.
navigating the company through challenging times,
Right.
including the Pentagon Papers controversy.
Wow.
Buffett admired her resilience,
Hmm.
her commitment to journalistic integrity,
Yeah.
and her sharp business acumen.
Okay.
He saw a management team that was both capable and trustworthy,
Right.
a crucial factor in his investment decisions.
So it sounds like he found a solid business
Yeah.
with strong leadership at a bargain price.
He did.
What happened next?
Well,
Did the investment live up to his expectations?
it did.
Okay.
But it took time.
Right.
The Washington Post's stock price didn't soar overnight,
Yeah.
but Buffett, with his trademark patience, held on.
Okay.
He knew that the company's intrinsic value would eventually be reflected in its market price.
And that's a key takeaway, isn't it?
It is.
Investing success isn't about instant gratification.
Right.
It's about having a long-term vision and the discipline to stick with it.
Precisely.
I see.
The Washington Post's return on equity,
Okay.
a key metric for Buffett, was decent, but not spectacular when he bought it.
Got it.
Return on equity, by the way,
Yeah.
measures how effectively a company is using its assets to generate profit.
Thanks for clarifying that.
Yeah.
So the initial return on equity wasn't amazing,
Right.
but what happened over time?
Within a few years, the return on equity doubled,
Wow.
exceeding the market average and outperforming other newspapers.
Okay.
This underscored the power of looking beyond just the current numbers
Yeah.
and assessing a company's potential for growth and improvement under the right leadership.
This is a great example of how Buffett's principles translate into real-world success.
It is.
He identified a quality business with a durable moat led by a strong management team and purchased it at a discount to its intrinsic value.
Yes.
Then he patiently waited for the market to recognize its true worth.
Exactly.
That's awesome.
It's a classic Buffett play.
Okay, cool.
Now for our next case study.
Okay.
Let's look at a company that might seem to defy Buffett's usual criteria.
Okay.
Geico.
Geico. Isn't that an insurance company?
It is.
I thought Buffett shied away from complex industries he didn't fully understand.
You're right. Insurance can be a tricky business.
Yeah.
But in Geico's case,
Okay.
Buffett saw something special.
Okay.
A remarkably simple and efficient business model that he could easily grasp.
Okay. I'm intrigued.
Yeah.
Explain how a company that deals with risk and complex calculations can be simple.
Geico's model at its core
Yeah.
was about cutting out the middleman,
Yeah.
the insurance agents,
Right.
and selling directly to customers.
Got it.
This allowed them to offer lower prices while still maintaining healthy profit margins.
Right.
Buffett understood this model and saw its potential for disrupting the traditional insurance industry.
That makes sense.
Yes.
So he was drawn to Geico's innovative approach and its ability to undercut the competition.
Yes.
But wasn't Geico facing some serious challenges when Buffett first invested?
You're right. In the mid-1970s, Geico was on the verge of collapse,
Oh, wow.
facing massive underwriting losses and a dwindling cash reserve.
Right.
It seemed like a risky bet,
Yeah.
even for a seasoned investor like Buffett.
This doesn't sound like the margin of safety we talked about earlier.
Right.
Why would he invest in a company in such dire straits?
Because he saw beyond the immediate crisis.
Okay.
He recognized that Geico's core business model, its low-cost advantage,
Yeah.
was still intact.
Right.
And more importantly, he
Yeah.
believed in the new CEO, John Byrne, who
Okay.
had a reputation for turning around struggling businesses.
So he was betting on the jockey as much as the horse?
Uh-huh.
He saw the potential for a comeback under the right leadership.
Exactly.
Wow.
And once again, his bet paid off. Byrne implemented drastic cost-cutting measures,
Right.
streamlined operations,
Okay.
and refocused the company on its strengths.
Got it.
Within a few years,
Yeah.
Geico went from losing millions to posting record profits.
Another impressive turnaround story.
It is.
It seems like Buffett has a knack for spotting hidden potential even in companies facing adversity.
He does.
That's amazing.
It's about having the vision to see beyond the headlines
Mm-hmm.
and identify the underlying value that others might miss.
So we've got the Washington Post,
Yes.
a classic example of finding a quality business at a bargain price,
Right.
and Geico,
Mm-hmm.
a story of recognizing a company's potential for a turnaround under strong leadership.
Yes.
What other case study can we explore to illustrate Buffett's principles in action?
Let's move on to Capital Cities ABC.
Capital Cities ABC. Okay, ready to dive in. Tell me more about this investment and what made it so unique.
Yeah.
So Capital Cities ABC, this was a bit of a departure for Buffett, wasn't it?
It was.
He was known for bargain hunting,
Yep.
but this time he was willing to pay a premium.
Yeah.
What made this company so special?
It all came down to management.
Okay.
Capital Cities ABC was led by Tom Murphy and Dan Burke,
Mm-hmm.
two exceptional executives known for their operational brilliance and capital allocation skills.
Right.
They were masters of cost control,
Okay.
and had a knack for growing businesses both organically and through strategic acquisitions.
Okay, so strong management was a key factor.
Yeah,
But what about the business itself?
right.
What did Capital Cities ABC actually do?
They were in the media business,
Eh,
owning a collection of newspapers, television stations, and radio stations.
Got it. So a familiar industry with
Yeah.
room to expand.
Right.
But what specifically caught Buffett's eye?
The company's exceptional cost-cutting abilities.
Okay.
They were incredibly efficient operators,
Right.
squeezing every ounce of profit out of their assets.
Wow.
And this talent became even more evident after their acquisition of the ABC network.
So they were lean and mean, maximizing profits. Sounds like a classic Buffett pick, even if the price tag was higher than usual.
It does.
But did this investment pay off?
It did.
Okay.
But as with many of Buffett's investments,
Yeah.
it required patience. The
Nice.
market doesn't always recognize value immediately.
Right.
Capital Cities ABC's stock price didn't soar overnight,
Mm-hmm.
but Buffett, with his long-term perspective, held steady.
That long-term perspective again.
Yeah.
It seems like a recurring theme in Buffett's success.
It is.
But how did he know it would eventually pan out?
He believed in the company's strong fundamentals
Okay.
and the exceptional management team.
Right.
He knew that eventually
Yeah.
the market would catch up to the reality of the business's performance.
Okay.
And as he'd proven time and again,
Right.
he was right.
Another example of his discipline and trust in his analysis.
Yes.
So we've seen how Buffett applied his principles across different industries,
We have.
from newspapers to insurance to media,
That's right.
adapting his approach as needed. But what are the bigger takeaways here?
Right.
What can we, the average investors,
Yeah.
learn from all of this?
That's the beauty of Buffett's story.
Okay.
He's often portrayed as an investing genius,
Right.
but his success isn't about magic or complexity. It's about a system,
Got it.
a set of principles that anyone can learn and apply.
So it's not about being a genius. It's about having a sound approach and the discipline to follow it.
Exactly.
I like that. Can you break down some of the key lessons for us?
Absolutely.
Okay.
Patience is paramount.
Right.
Buffett is the ultimate long-term investor.
Yeah.
He doesn't get swayed by short-term market fluctuations or chase the latest hot stocks.
Right.
He focuses on finding quality businesses with enduring value
Mm-hmm.
and holds them for years, sometimes decades.
Easier said than done, right?
It is.
Especially in today's market where everyone's looking for quick wins.
Yeah.
Any tips for cultivating that Buffett-level patience?
Think like an owner, not a trader,
Okay.
when you buy a stock.
Yeah.
You're buying a piece of a business.
Right.
Focus on the company's long-term prospects,
Mm-hmm.
its competitive advantages,
Yeah.
and its ability to generate cash flow.
Okay.
Tune out the noise and focus on the fundamentals.
Think like an owner. Got it.
What else? Stay within your circle of competence.
Okay.
Only invest in businesses you truly understand.
Right.
Don't get caught up in the hype and invest in something just because it's popular or seems promising.
Yeah.
Do your research, understand the industry,
Okay.
the company's financials,
Right.
and its competitive landscape.
That's a great reminder.
Yeah.
It's easy to get tempted by things we don't fully grasp.
Absolutely. And don't forget about risk management.
Okay.
Diversify your investments across different industries and asset classes
Right.
to minimize the impact of any single investment going sour.
Got it.
And avoid excessive leverage.
Okay.
Borrowing too much can magnify your losses.
Diversification and prudent use of leverage.
Yeah.
Solid advice. Any final pearls of wisdom from the Oracle of Omaha?
Remember the psychological aspect of investing.
Okay.
Master your emotions and biases.
Right.
Don't let fear or greed drive your decisions.
Mhm.
Stick to your principles even when the market is panicking.
Yeah.
Develop a rational, disciplined approach,
Okay.
and you'll be well on your way to investment success.
This has been an incredible deep dive into Warren Buffett's world.
It has.
We've explored his core principles,
I have.
from patience and circle of competence to the importance of understanding intrinsic value and managing risk.
Yeah.
We've even seen how these principles translate into real-world success
Right.
through some of his most famous investments.
Yes.
Any parting thoughts for our listeners?
If you could invest in just 3 companies for the next decade, what would they be and why?
Wow.
Think about those businesses you believe in,
Okay.
those with enduring value and the potential to thrive over the long haul.
Mm-hmm.
Apply the principles we've discussed today
Right.
and make your own informed investment decisions.
That's a great challenge.
It is.
It forces you to really think like Buffett.
Yeah.
considering the long-term potential of businesses and applying his wisdom to your own investment strategy.
Right.
Thanks for taking us on this journey into the mind of a master investor.
It was my pleasure.
Really appreciate it.
Remember, investing is a marathon, not a sprint.
Okay.
Stay curious, keep learning, and invest wisely.